Home ownership is often talked about as a milestone, a sign that someone has made it. In Kenya's real estate market, new developments have risen and listings are moving daily. The market seems to be growing, but beneath the visibility, access to ownership is still very uneven.
Statistically, around 86% of the workforce in Kenya are gig workers, essentially non-salaried. So that's a really, really big chunk.
Buying property is not just about buying a home that you like. It's about meeting thresholds like income consistency, credit history, deposit requirements, financial structures, and documentation.
When you have a salary, it's rather obvious. Your income is predictable. They know you're earning X amount. And for that particular reason, then they can rely also on your pay slip in terms of making those monthly repayments. Unlike when you are an unsalaried individual, whereby you have multiple sources of income.
Why would a consistent renter struggle to qualify for ownership? In this episode, we sit down with Christabel Ojuok. She's worked for companies like Knight Frank, Andela, and Nesti, where she currently sits as a co-founder. Together, we discuss how housing can become accessible, what needs to change for ownership to reflect the real economic times, and why platforms like Nesti are emerging in response to gaps between how people earn and how systems recognize them. Now, before we get into the episode, we have to give a big shout out to our partners who've been rocking with us this season, and that is Tanqueray and Art Cafe Gastrobar. Art Cafe is the place to be if you're trying to have progressive conversations after hours, and so they have always been rating us with these fantastic Tanqueray-based cocktails, and they have happy hour offers from 4 to 8 p.m. every single weekday, and on the weekends it's an all-day happy hour. So make sure you grab a drink here at Art Cafe Gastrobar and drink responsibly after hours. So Christabel, thank you for joining us on the podcast.
Thank you for having me.
Real estate in Kenya is very active. Developments are going up, but access to ownership still remains limited to many. So from your experience, where is the system actually working and where is it quietly locking people out?
Okay, so it's an interesting time within the real estate landscape. I'm sure if you drive around Nairobi, you're seeing so many buildings coming up.
So many.
And after pretty much a period of like a 2-year cycle, buildings are sold out, so we have new and more pipeline coming into the market. So in terms of what's working, I'd talk about new sort of products that we have in the market, specifically affordable home loans. So essentially, unlike how it was before, because if you wanted to buy real estate, your options were cash, or even if it was a mortgage, the interest rates were very high. But right now, because of affordable home loans, so you have a single digit interest rate at 9.5% per annum. So that's made it more accessible to a number of people in terms of getting started. So all you need is just that deposit, and then now your monthly repayments would essentially be easier. However, on the flip side, in terms of what's not working, is that as much as, yes, this offering is out there in the market, it's still, a lot of people are still locked out from accessing it. Obviously, for some of the reasons which we'll get into as we progress further with this discussion.
When you were managing properties previously at Knight Frank, what patterns did you start noticing about who participates easily and who struggles to?
So when I was at Knight Frank, that was pre-COVID. And the landscape has changed a lot since post-COVID from 2020 till now. So prior to that, essentially the key participants were, I'd say, the wealthy people. Why? Because the options which were available, first of all, in terms of even the offering, we had low-density properties, much bigger spaces, but then higher price points. So what that meant is you would only get access to it if you're in the monies. But then post-COVID, what happened is we got a new influx of new type of developers, and they pretty much took time to understand the Kenyan market by offering now what essentially would be more affordable products. So what happened is, let's say typically you'd have like a 3-bedroom house, which prior to COVID would be around 180 square meter. I know that's a bit technical, but to put it into context, so right now what has happened is you can find a 3-bedroom, but then at around 120 square meter. So the holistically price has gone down, But then in terms of price per square meter, it still remains the same. So what that means is that because of obviously economies of scale, more people are now able to afford because of the price point. So if it's a 1 bedroom, you can even find a 1 bedroom at, for example, 5 million. And like back in the day, a 1 bedroom would probably be twice that amount. Yeah, so it's very interesting to watch that.
On paper, the path from renting to ownership seems straightforward, but in reality, what are some of the biggest friction points that you've noticed that stops people from making that transition?
So just piggybacking on my previous point, it's now more possible for a couple of people to enter into that property space. And again, combining that with the offering for affordable home loans, it means essentially even you, if you wanted to purchase real estate today, you can actually get started. Now, that's on paper. When it comes to the ground, typically before you get started, one of the biggest barriers that I've seen when I sit across the table with prospective buyers or people who are even in that process of transitioning, the challenge tends to be raising that deposit, because when you're about to buy a property, you need to have some form of deposit. Minimum 10%, on average tends to be 20%. So if you haven't saved that up, then it's going to be a challenge in terms of you getting started. So that's number one. Then let's say you have this deposit, now you want to, you've seen something that you like and you want to get started, and now we pair you up, for example, with a financier. Now the challenge there comes in as to whether are you employed, or do you actually earn a salary, or are you sort of like an entrepreneur, a freelancer, a gig worker? Because that essentially will either mean that you get access to that facility or not. So when it comes to the ground, there's are still a bit of friction as far as that is concerned, which essentially means today quite a number of people are locked out when essentially they could take advantage of this offering and become property owners.
And what's something about mortgage or financing process that looks logical from the outside but breaks down in practice?
First of all, there's a gap in the market in terms of mortgage as a product in itself. Why? Because of, first of all, the interest rates. So we tend to do a lot of comparison. You do street math. So like, okay, today if I had, for example, or that a house is worth 5 million and I'm getting access to a mortgage, by the time I finish paying that, let's say in 10 or 15 years, I'll have paid X amount, right? So people tend to do lots of straight line math. But then what they fail to understand is that when you're getting financing to acquire an asset, which essentially you don't have and you want to, there's always going to be an element of cost of capital, right? That's number one. Then secondly, we tend to do a lot of comparison between the market here in Kenya and Africa at large in comparison to the West, because on the other side, then mortgage rates tend to be relatively lower, so probably like at 6%. However, what people fail to understand is in Kenya, again, looking at the affordable mortgages at 9.5, there's so many other countries outside South Africa and probably Egypt where interest rates will be 20%, 25%, 30%. So we really, really have it good. So there's a gap as far as having that information is concerned. But then secondly, also the other issue is access in terms of what I talked about. So it's presently available, but for the few. But then obviously if that was to open up, then more people will be able to get that opportunity to get started.
I want to shift conversation slightly towards your personal career. You've spent years managing large commercial properties before moving into this startup environment that you found yourself in right now. What did that shift from a structured environment to a fast-moving one like Andela reveal to you about how different systems operate?
When I was at Knight Frank, that was a proper corporate setup, right? And so you come in and you're sort of a cog in the wheel. Actually, that's what I was looking for. So you fit in the system, and pretty much you pick up their SOPs.
Yes.
Everything works essentially. But now when it comes to the startup world, it's very agile. So it's fast-paced. Decisions are made every other day. You have to be very flexible in terms of even your thought process and how you work. So that was a very key differentiator from moving from corporate to a startup. And obviously took a while, but I had to adapt very quickly because you're still trying to set up, you're still trying to find your footing, you're still trying to understand your customers, even as you're scaling. So it does take time, because even the corporate, prior to it being that, it took years and years of all those systems and SOPs to be in place in terms up to the point where they got and become stable.
To become more established.
Yeah, exactly.
Would you say it's an environment to prefer over working in corporate?
I mean, right now, yes. Again, because things are moving very quickly, even your customer demographic and things like that. So it's something that I've come to appreciate, just being agile. But then obviously that took a really long time, because prior to moving to a startup, I was in corporate for about 7 years. So it had sort of been ingrained in me, but over time, I've had to, adapt.
In the context of you were working in corporate, probably you started noticing some loose ends, and you started having questions about not only what the parts of it need to be rebuilt, but also you're the person to do the rebuilding. So at what point, talk me through the cognitive dissonance that maybe happened before you decided to make the switch?
The thing is, when you're working in corporate, there's sort of like a structure and a set way of working. It may be a challenge in terms of moving vertically and like horizontally. There's very little room to transition from, let's say, one department to another, because you've been doing this one thing and you know how to do it well. So what do you mean you want to now move into a different department and start experimenting? There's no time for that, and there's no room for that. So even at the point when I was transitioning from now corporate to move into a startup, it had gotten to a point where I had been doing what I'd been doing for a very long time, and it was the same thing over and over. Like I could sleep and do it, right? So I had to unplug myself from that environment and go to a completely new area, and just have that flexibility and wisdom to learn during that transition process.
Let's talk about the products that you're building now, which is Nesti. Nesti, from my understanding, came out from seeing a repeated gap in the system. So what was the moment or the pattern where you realized, okay, this isn't a small inefficiency, this could be a structural problem? What was the problems you identified that Nesti is solving for?
We had been in the market for a while, whereby we had helped, over a period of 2 years, where we had helped so many people transition from rent into owning. Initially, when we started, we were a property and mortgage marketplace. So what that meant is you could go on our platform, you key in your income, and then you'd be able to see how much of these affordable home loans you could get, as well as what your repayments would look like, and then we'd pair you up with vetted properties in the market. So what we did is reduce that whole process of house hunting from months to minutes, because you'd be able to literally have all the information at hand. And with that, what we realized over time is that a lot of our customers were being left out. So at the point when you've taken a customer, you've seen the property, you like the property, you even have the deposit and you're ready to get started, then the gap was customers who were salaried, essentially. The process was very swift for them. But then on the other side, where you had like gig workers or any other customer who essentially didn't have a salary, then it was document after document. So you're being asked, okay, submit this and submit that, and then at the end of that process, many of them fall off in the sense that they weren't getting approved. So we realized, and that was the biggest chunk of our customers. So we realized that it's more of a systemic issue, because it's not that they couldn't afford the monthly repayments, because even if you look at some of the properties where they had selected, what essentially would have been their monthly repayments is what would have matched the mortgage, and they're already paying that rent anyway, right? So that's when we realized, okay, there's a bigger problem to solve here, and that's how one of the key reasons as to why Nesti was born.
And why do you think this gap, especially around non-salaried individuals versus salaried individuals, has persisted this long?
Statistically, around 86% of the workforce in Kenya are gig workers, essentially non-salaried. So that's a really, really big chunk. But if you look at the system, it's been working all along, and it's been working if you do 186 for the 14%. It's less risky. There isn't too much innovation around it, so it's been working. So, I mean, unless you've experienced that problem firsthand, then there was really no need to solve it. And that's where we came in after experiencing and seeing what our customers were going through. So I believe the challenge primarily has been in terms of, first of all, even if you look at the rent ecosystem, everybody pays rent to their landlord. There's no single channel whereby you can track it. So, yeah, it's just been all over the place as far as the rent is
So
concerned.
if I get it correctly, there's a significant difference if I'm someone who's an entrepreneur to be able to invest in real estate or buy my own house or pay mortgages, as opposed to someone who is working an 8 to 5 who may have a regular salary, but the margins are significantly lower than what I'm making from time to time as an entrepreneur.
Yes, absolutely.
Okay. And could you talk a bit more about that more broadly?
Yeah, so the challenge that, at least from the conversations that we're having with the banks, stems from a risk element, in the sense that when you have a salary, it's rather obvious. Your income is predictable. They know you're earning X amount. And for that particular reason, then they can rely also on your pay slip in terms of making those monthly repayments. Be it a mortgage, be it a short, let's say if you're getting a facility for a year or two. Unlike when you are an unsalaried individual, whereby you have multiple sources of income. So I'm not able to, for example, I can't say, okay, Alice, do you have a contract for this? Let's say you have a gig today, in about 2 weeks' time, you have a different gig altogether. So it's not very easy for them to map out your income on a month-to-month basis. And for that particular reason, then you're deemed as somebody who's very high risk. Yeah. So our premise as far as Nesti is concerned is, but Alice pays rent at the end of the day. And the fact that you're able to pay rent, which is consistent on a monthly basis, that in itself is an indication of your income to a greater extent, because essentially rent would form up to 40% of your income. So we are now taking that and now tracking it to be able to prove your reliability as a customer who essentially should be able to access credit at the same time as somebody who's salaried.
And what are you using to track this?
So we have an app available on the app stores. So essentially when you get on the app, you get to download it and you key in your details, which now include your rental details as well as your landlord details. So when it comes to at the beginning of the month when you pay your rent through the platform. We've integrated to mobile payments, so you're able to, it's the same process that you would essentially
typically go through.
Yes. Then once you pay that, so we track it. It runs through our system and we track it. And then with that, we're able to build a profile for you, which we're calling, it's an alternative credit profile, which we're calling a rent score, primarily based on your rent payments. So we look at a couple of things. So how you pay rent in terms of, do you pay it in full? Do you pay it partially? When do you pay it? Do you have arrears and things like that? So, yeah.
You and I both know that real estate historically has been significantly slower than other industries to adopt technology.
Yeah.
So where does technology actually change outcomes in real estate, and where does it fall short? Are you seeing more technology adaptation? Let me say that.
It's taken time for the industry to adopt to tech. And when you talk about technology in real estate, so there's two. You have your Contech, which essentially is construction technology, and then you have your Proptech. So when you talk about Contech, this is, you're looking at things like 3D buildings. You're looking at, all these panels which have come up. So what that does is it reduces now the time frame of putting up a structure. Again, something that could take you probably 1 year can now be reduced to even 3 months.
Yes.
Then when you talk about now, Proptech is now the systems, the software that helps improve efficiency as far as things like collection is concerned, even mapping out data, etc. So Contech has come a long way. Proptech, in certain elements, it's still picking up. It's, frankly speaking, it's been one of the industries that has been very slow in terms of adapting to technology. Primarily because even the key stakeholders are a bit older, so they may not be very agile in terms of adopting technology and things like that, but it's significantly improving.
What's been harder than expected when introducing a tech solution into this space and into this market?
If I look at the landscape, it depends on who you're targeting as your customer. So for example, if you have, like what we're doing at Nesti, essentially we had to, figure out who do we go to first. Is it the tenant? Is it the landlord? Is it the bank?
Yeah.
Yeah. So, and ultimately we made a decision because we were building for the customer to go to the customer first. So, in that element, when you start, obviously there's lots of questions because I've been paying my rent in a certain way. So why are you telling me right now to change how I'm doing that? And really, you really have to come out strongly as far as the value prop is concerned. So it's picking up in terms of adoption, but then there's still a long way to go as far as that is concerned. Yeah.
I'm curious to hear your thoughts as to why you think that something as consistent as rent payment has never been taken seriously as a form of creditworthiness.
In Kenya, we're the first ones to do it, but you'd actually be surprised to learn that it is happening in South Africa. So in South Africa, there's an alternative credit bureau that does track rent payments as well as other things like, for example, utilities. And again, here, back to my earlier point, the system has been working for the 14%. So why change it, right? But then ideally, just think about the impact that you can have if you build for the vast majority. You shake up things as far as that just changing how the ecosystem has been working for so long. But then I also have to acknowledge that the other challenge has been, unlike other markets, for example, in the West, whereby things are structured in such a way that you could trace even who the landlord is, then in that element it would be easier. Unlike here, where landlords are everywhere, and you cannot, there's no sort of like association or a central point where you can say, okay, these are the landlords, and if you're making a payment to Alice, for example, Alice is a landlord. So it's also the work that goes behind tracking those rent payments that the amount of work it's not an easy one.
You're building for tenants, landlords, and banks all at once, from what you're expressing to me.
Yeah.
Where do these incentives align, and where do they fundamentally clash?
The good thing is that with lots of innovation happening even within the banking system, the financial ecosystem, the fintech landscape is changing a lot. So even the financial banks in that sense have realized that, okay, there's this whole segment, customer demographic, that's been locked out. So earlier on I had mentioned when we went to market, it was a challenge because when we go to the customers are asking, okay, so which banks are you working with? When you go to the banks are asking, okay, so how big is your portfolio? So it was sort of like a chicken and egg type of situation. But then we said, so if you look at the rent score, the base of it serves three fronts. It serves the banks, it serves the tenants, it serves the landlords as well. So landlord, it's a no-brainer. It's straightforward. You can screen your tenant, you're happy. Now with these two, merging the tenants with the financier has been a bit of a challenge, but we've sort of managed to sort of have a workaround around it, in the sense that we do now have sufficient. Our customer base has grown, and the banks are listening. And with that, we are able to combine those two together. And the best thing about it is that we'll actually be launching with our first financial partner come July. So because they needed a lot of data.
Are you going to share with us?
For now, I can't reveal who it is. But soon, yeah, we'll be making that announcement. So that will be very, very exciting because then it means it's going to open up lots of opportunities.
What's your business model?
In terms of how we earn revenue?
How do you make revenue?
Okay. So when customers pay rent, there's a transaction fee. Essentially, it's a convenience fee. We actually don't call it a transaction. It's a convenience fee for you to be able to build your rent score. And that ranges anywhere from 50 shillings all the way to 150 shillings per month. And then secondly, there's also an element of screening. So when a landlord gets to screen a tenant, then we do make money from that. Then third, on the basis of financing, again, even when the banks want to now lend, for example, to somebody like me who doesn't have, I fit within that customer demographic, then they'd also be able to use our platform in terms of screening, and they'd be able to, like we also get to make money from that. Yeah. At least for now, those are our revenue lines, and obviously as we grow and bring on board more products, and it's going to be additional revenue lines.
More products?
Yes.
What are some of the plans you might envision yourselves getting into?
Yeah. So ultimately, what we want is customers to get access to credit, obviously in the short term, but then even in the long term. So one of the key things that we are keen on is because we do lots of customer engagement, and people want to own homes using their rent score. So one of the pathways could be through a rent-to-own model. The other pathway could also be through a mortgage. So rent-to-own is development specific in terms of it will only be available in a certain development. When it comes to, obviously, if you get a mortgage, then it opens up more opportunities in the sense that you can buy any property that you want. So ultimately, that's our goal. It's sort of a step-by-step. You start short-term, and then eventually you get to progress to long-term.
What are some of the risks involved for me as a tenant who's using your platform to sort of build my rent score? For me as a bank, giving loans to customers to be able to get that credit that they're seeking, and even for me as a landlord who's receiving payments, what are some of the risks involved holistically in the model that you've structured?
So on the landlord side, there's no risk involved because rent payments are done in real time. So the same way you typically pay your landlord, for example, if it's through M-Pesa and they get the cash in real time, is the same way, which happens through our platform. On the financier side, again, because it's a new product that they are warming up to, essentially what that would look like is they would start with short-term lending and then scale it to mid-term and then eventually long-term. Because you have to monitor a customer's profile before you get to a point where you can comfortably give them a large chunk of money. So, yeah.
Based on what you've seen, what's one belief or several beliefs about who can own a home that needs to change?
Interesting. In this day and age, because of all the advancements and innovation that's taking place, literally anyone with a source of income, and to be fair, let's say if you're earning on average around 150,000, then yes, you can actually get to own a home. The premise for the longest time has always been this is something for people who are, you're probably earning 700 and above, but the game has changed. The game has changed because innovation is happening on two fronts. It's happening on the financial side of things, whereby, like for example, us as Nesti, we're trying to create access as much as possible. But it's also happening on the development side, whereby we have developers who are thinking of products like, for example, a rent-to-own, whereby if you at least done that 10 or 20%, then you get an opportunity to get started, and then you just do your monthly repayments, typically the same way that you do as rent, over a prescribed period of time. So that has made access to real estate way much more affordable and easier, unlike how it was in the past. So yeah, anyone can literally work their way there and get an opportunity to own a home.
Have you heard that? You can actually own a home. It's not as complicated as people make it say in this day and age. So maybe you can tell our audience once again where they can engage with Nesti.
Okay. You can find Nesti on the app stores. So whether you're on iOS or Android, so just search Nesti. You'd be able to see the app, download it, and then get started. You can also find us on Safaricom's My One app. If you scroll down under the utilities section, you'll see Nesti there, and register and get started.
How about you, Christabel? How can our audience engage with you?
So I'm on Instagram. My handle is Christabel Ojuok. You can also find me on LinkedIn, same Christabel Ojuok, and let's engage and interact. And
Thank you so much for joining us on this episode of After Hours, and thank you, audience, for sticking around. If you've made it this far into the episode, we appreciate it. Make sure you check out My Tech Story Africa on our website at mtsafrica.co, My Tech Story Africa on all the social media platforms, and you can also check out our other shows: Admin Access, hosted by Dominic and Evans, and Peer Pressure for one of our clients, Honeycoin, hosted by Lauren Derry. And with that, I shall see you in the next one. Cheers.